Today, some important changes in the economic weather. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. There are two things that I want to discuss today. The first is the news that came in overnight that the Fed kept their cash rate on hold and is now indicating no change this year and indeed lower rates potentially ahead. This is a significant switch from a few months ago. And locally, we had the latest unemployment data. And while superficially it might look okay, we think there are some warning signs there too. So today we're going to look at both of these very important sets of data and try and work out what these early indicators may mean in terms of future direction both locally and internationally. So first to the Fed. Their release said that information received since the January meeting suggests that the labour market remains strong, but the growth of economic activity has slowed from its solid rate in the fourth quarter. Payroll employment was little changed, but job gains have been solid on average in recent months, and the unemployment rate has remained low. And recent indicators point to slower growth of household spending and business fixed investment in the first quarter. On a 12-month basis, overall inflation has declined, largely as a result of lower energy prices. Inflation for items other than food and energy remains near 2%. And on balance, market-based measures of inflation compensation have remained low in recent months, and survey-based measures of longer-term inflation expectations are little changed. So, the committee decided to maintain the target rate for the federal funds at 2.25% to 2.5%. And the committee continues to view sustained expansion of economic activity, strong labour market conditions and inflation near the committee's symmetric 2% objective as the most likely outcome. In the light of global economic and financial developments and muted inflation pressures, the committee will be patient as it determines what future adjustments to the target range for the federal funds rate might be appropriate to support these outcomes. Now that is quite a different tone, in my view, from just a few months ago, when of course there was talk about continuing to lift rates, the system being on autopilot, and the market expecting considerably higher rates into 2019 and 2020. Things have substantially changed. My conclusion that if anyone was losing sleep about the prospect of the Fed getting more hawkish in the coming months, they will be able to get some shut-eye for some long period of time now. Because citing slowing economic growth, the Fed held their rates, and those strong signals really show that there are going to be no more rate hikes at all this year. And that's interesting because, in fact, going into the meeting, many investors were still thinking that the Fed may have another 2019 hike in its pocket, but I don't think that's the case now. And it's worth noting that although stocks initially reacted positively to the Fed announcement, it's not necessarily positive for the economy to see the Fed cut its GDP estimate for 2019 to 2.1% from 2.3%, and it also trimmed its personal consumption expenditure inflation forecast to 1.8% from 1.9%. Now, these are still solid numbers, but they are not stellar, and they continue to slide. Now, along with its statement, the Fed issued an updated dot plot showing where federal officials see rates going in coming years. What might have been surprising was that the Fed's forecast is not only for no change in rates this year, but for rates to be 50 basis points lower by the end of 2020 than it had been forecast just 3 months ago. Back in December, the Fed had forecast rates to be in the range of 2.9 to 3.4% by the end of next year, and now that range is 2.4 to 2.9%. And looking at the last dot plot versus the new one side by side, it seems pretty striking how estimates have come down. That's especially true for next year, which looks far less hawkish than expectations just a few months ago. And in his post-meeting press conference, Jerome Powell, the Fed chair, said that weakening economies in Europe and Asia were weighing on the US economy. Now, as a result of that, the US benchmark 10-year Treasury yield traded near 2-month lows below 2.59% before the Fed's decision on Wednesday, and rates have fallen from above 3.2% as investors factor out chances of more Fed rate hikes and as the global economy slows. And so weaknesses from China and Europe must be hitting those rates too. Now, these lower rates in the US, which will translate into lower rates into the capital markets, may have an impact on bank funding here locally in Australia, because there has been an elevated risk premium on new bond issuance from the banks. And remember that banks have between 20 and 30% of their funding into overseas markets. And that risk premium is not directly related, however, to the cost of funds as compared with the Fed. There are a whole bunch of other questions relating more to the local economy here. So my view is there may be some slight easing of funding rates, but the risks in the local economy here are not just connected to what the Fed does. And as a result of that, I still think that many banks here in Australia will still continue to struggle with net interest margins. And so to the other piece of news in the local market here. The ABS released their employment data for February today. And we'll start by looking at the trend in seasonally adjusted unemployment and participation rates to February 2019. So we can see that the trend unemployment rate is sitting at 5%. To make sense of this chart, read this off the left-hand scale, unemployment percentage. And the seasonally adjusted data is just slightly lower at 4.9%. So we can see that there has been a trend of easing unemployment. And of course, that's one of the things that the government has been celebrating in recent releases. It's also worth noting, however, that the rate of decline looks to me to be easing off. And then the other equation is the participation rate. So this is the proportion of those in work relative to the population. And you can see on the right-hand scale that that's above 65.5, and it's just easing down a tad. And the seasonally adjusted version of the data also shows a little bit of a fall. Now, of course, with participation rates, the higher the number, the better. Whereas with regard to unemployment rates, the lower the number, the better. But I want to look at a series of data today that is full of noise and therefore may mean nothing, but it potentially also could mean something. In fact, it could be an indicator of a significant change ahead. What I'm talking about here are the original unemployment statistics across the states to that same February date. So let's start looking at New South Wales. This is the original data, so it's going to be noisy, and you could argue that data over the year end is always somewhat difficult. And as it's original data, it doesn't take account of month-by-month movements or season adjustments. And as a result of that, of course, there are some upticks around the end of the year, particularly as people take holidays and leave and change jobs. But what's quite interesting is that since September, October time, we have definitely seen a significant rise in New South Wales. Now, New South Wales is still a very low rate, below 5%. But if in fact unemployment in New South Wales starts to tick up, then that's going to be an important leading indicator. And if you look at Victoria, we can also see that there's been, again, a strong rise. Now, you can argue the same last year, but I think it's quite important to watch these numbers. If you then look at some of the other states, this is Queensland, you can see that in fact the unemployment rate fell a little. And then we can look at South Australia, somewhat consistent. Western Australia, obviously a higher unemployment rate, but looks as though there's a little bit of a fall. And in Tasmania, just a little bit of a fall, but from a very high level. But I am quite concerned about the indications in Victoria and New South Wales. Remember that 60% of property is in those two states. And if it were to be the case that this is a turning point for the unemployment number, it could actually be a significant factor ahead. And Westpac makes the point that we should be very cautious about the January and February releases given the large underlying seasonality in the months. However, they suggest that there does appear to be a change in momentum in employment. It has slowed. So they say there is nothing in this release to make them change their view that unemployment growth will take a breather through the first half of 2019, leading to a lift in unemployment. So Westpac said that in February, in reverse to the January result, the mix of employment gains painted a soft picture, with a 7,300 loss in full-time employment offset by 11,900 gain in part-time employment. However, the hours worked was a bit upbeat in the month, with total hours worked up 0.2% and total employment was flat in the month, as hours worked per person gained 0.1% due to average hours worked rising for both full-time and part-time employees. And in the year to February, total hours worked was lifted 2.2% over the year, which is on par with the 2.3% over the year pace for employment. So they said that despite the soft print on employment, the unemployment rate fell to 4.9% season adjusted. And the participation rate fell to 65.6%, resulting in a small decline in the labour force of 7,100. And they say that at this stage it appears that both male and female participation is levelling out in trend terms, and they'll be closely watching where they go next. They did say that they expect both to edge lower through 2019 as employment growth stalls. And they make the point that February was a soft month for employment growth across the states. Employment fell 5,800 in New South Wales, and unemployment lifted to 4.3% from 3.9%, which was a 30-year low in unemployment in that state. In Victoria, unemployment lifted 5,700, but with a lift in participation, the unemployment rate lifted to 4.8% from 4.6%. Queensland employment lifted in February 6,400, but a decline in the participation saw unemployment rate dip to 5.4% from 6.1%. And in Western Australia, employment rose 2,800 with a 1 percentage point fall in unemployment to 5.9%. And that was supported by a 0.6 percentage point fall in participation. And South Australia saw a lift in employment of 3,800 in February and saw the employment rate ease back to 5.7%, which is 0.6 percentage points lower. And it's also worth noting, they said, that for all the strength in the labour market, the underemployment rate only declined 0.2 percentage points. So far, there has been further improvement in the rate, falling from 8.3% in December to 8.1% in February. But they suggest that we should be cautious about these data sets. And finally, they say that for 2019, they're looking for a pause in the pace of employment growth due to the economic uncertainties surrounding the federal election, at the same time as they expect to see a moderation in momentum in New South Wales and Victoria on the back of a moderation in housing activity. With reasonable estimates for the participation rate, their weaker jobs growth profile has an unemployment rate lifting to 5.5% in the second half of 2019 and further by the end of 2020. Now, my point is simply this. I think that there is enough evidence building here to suggest that we are going to see unemployment rise ahead, and as a result of that, we are going to see economic activity continuing to weaken. So it's early days and on noisy data, but it seems to me that both the Federal Reserve move in the US and the indication of employment here in Australia suggests further economic weakness ahead. That's, by the way, in line with our scenarios, which we updated earlier in the week, and you can see that in a live show. Here's a link to that live show. And we'll be monitoring this data very closely over the next few months. And I'll make one other point, and that is that our SME survey data suggests that unemployment is rising in retail, construction, and in the finance sector. And those three areas are a large proportion of where the growth has been quite recently and is now turning into reverse. And significantly, a lot of activity was in Victoria and New South Wales. So I suggest this may be one reason why we are seeing the rates move as we are. And just a quick reminder, there will be a webinar on Monday at 12 p.m. Sydney time with Harry Dent. And Harry and I are going to discuss some of the economic dynamics both locally and internationally, and we'll touch on the Fed decision and also the unemployment data. And you can join the webinar by following the link in the comments below. The webinar is free for those who'd like to join, and I get no benefit from running it, but I think it's an important discussion, and whether you like Harry Dent and his views or not, he's always entertaining and thought-provoking. If you found this post useful or informative, please like the post and share the post, add a comment or question. I read them all. And if you haven't subscribed, please do so to receive future alerts by ringing that subscribe bell. And if you have subscribed already, many thanks. I really appreciate your support and participation. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.